Hello. It's time to talk about real estate calculations. And for some of you, this might be the topic you've been dreading most. But here's the deal I want you to make with me. Here's a pledge, an oath, whatever you want to call. Some of you have not taken a test for a while. And you might be feeling a little anxious, and I get it. Deep breaths. Some of you might have told yourself an internal story that you're not a good test taker and that you're terrible at math. And if you're rolling your eyes at me right now or giggling inside thinking, no, I really suck at math, I'm going to lovingly tell you to stop it. Stop it right now. One, you are perfectly capable of figuring this out. Two, you want to know how to do math so you can figure your commission checks, right? I mean, if anything for that. Number two or number three, whatever number we're on, even if you missed every single one of these, you can still pass the exam. You've got 80 questions. You need a 56 to pass. Salespeople, that means you will have 8 math questions on the exam, which still puts you to 72, which still leaves you, 15 questions for a room of error, 14, 15. Do I not know how to do math? I'm rounding. You still have room for error is my point. So if this really freaks you out, move on. But that means you got to master everything else. Otherwise, I want you to really work on your mindset because you can do this. Now, for the national exam, you've got 80 test questions and you've got 120 minutes to work through all that coursework. So that means that for every question you've got about 1 minute per question that you could afford to spend answering it. So if we've got 120 minutes minus 72 minutes, that means the math questions you could spend 5 or 6 minutes on. So all the other questions, if you gave it a full 60 seconds of attention, that means you've got 5 or 6 minutes to do just each math question. So some of you may choose to do the entire exam and then go back and just do the math. If you do that, you just got to pinky swear with me right now that you're not going to forget to go back and actually do those questions. You're not going to get to question 80 and think, hot diggity dog, I'm done. No. We don't want you to fail just because you didn't answer all of the questions. I'm going to go through with you though the outline, of course. And this is loan to value ratios. This is the amount putting down versus the amount being borrowed. If you've got $9,000 you're putting down and $180,000 loan, my simple way to remember that is to put the big number into the little one. So take 9,000 divided by 180, and then you got to do the decimal dance. Discount points, again, that is 1% of the amount being borrowed. So pay attention to how much they can borrow. Equity is going to be the difference in what you owe versus what the property is worth. And then again, that down payment amount to be financed kind of relates back to loan to value ratios. Okay. For property tax calculations and prorating that amount, I think you need to look for keywords of accrued or prorated. Now, in my experience, they have always used the 360-day method for calculating property taxes, not 365, because then you'd have to get out your shoes and take off your shoes and count your toes and fingers for a lot of you to calculate that. So in my experience, they've done the easy 360-day method, which means you take the amount of tax divided by 12 months, And then you take that amount and you divide it by 30 days. That's the formula. You don't need to worry about whether it's a leap year or not. So the 360-day method, you take the tax amount divided by 12, and then you divide that amount by 30 to get a daily rate. So just keep in mind, if you've got to do taxes accrued, which means the seller owes a credit to the buyer for the time they lived at January 1st through September 17th. Just keep in mind how many full months of taxes you need versus how many days. Because a lot of you are going to hear September 17th and think 9 months, 17 days, because September is the 9th month. You'll get that question wrong, but you won't realize it because the test is smart about your psyche, and they're going to give you that as an answer option. Trickery. But really, it's 8 full months through the end of August plus 17 days. So be very, very cautious. And if it says prepaid, that means the seller paid the tax bill the beginning of the year, and now the buyer owes them a credit for the time of closing to the end of the year. So September 21st, or I think I said September 17th, I'm sorry. Accrued, the seller would owe the buyer a credit January 1st through September 17th. If it's prepaid, the buyer is going to owe the seller a credit September 17th through December 31st. Okay, so watch for that word prepaid. Now, seller's proceeds at sale, we've talked a little bit about how that escrow money works. And on the closing disclosure, and that goes for the buyer's funds. We've got a transfer fee. This is also known as a revenue stamp. And they're going to give you the formula of maybe $1.60 per thousand. And that means you got to take the value divided by the increment. So in this case, it would be 1,000. You're left with 100. Multiply that by $1.60. That means your transfer stamp or transfer fee or revenue stamp would be at $160. Okay. Another good one that I don't know that they've got spelled out here very well, but it's principal, interest, taxes, and insurance. And this is what I'm going to call the principal interest payment using the mortgage factor chart. And I believe the mortgage factor chart, you could need to use that chart 0 to 4 times on the exam. It could be something that is really repeated. I'm going to come back to that. This is the broker only. And this is going to be net operating income and capitalization rate. We talked about this earlier, that I gave you this formula of income over rate times value. This is what that's talking about. So again, for you taking the broker exam, I'd maybe just write that formula down as soon as you get to the test center, just up in the corner. And again, it's income. I'm sorry, this is backwards for you. It is income over rate times value. So if you wanted to know the rate, you divide the income by the value. If you wanted to know the value, you divide income by rate. And if you wanted to know income, you would multiply rate times value. Hopefully you can read backwards. Now let's go back and pick up this principal and interest payment because I think that this could be popular for you. I've got this on my website under PSI. Let me go back for you. IowaRealEstateAcademy.com. Under resources, I've got PSI testing information. Now, first of all, here is the PSI guide. The outline that I've been doing in this whole series has come from this. I've gotten it typed out on the slides for you, I know, and I've gotten it for you in your sections, but here's the actual booklet. Some information on how to register. Here's a little exam prep guide handout, wink, wink. And then here is a mortgage factor chart. Let me turn this so that we can see it correctly. But this is already figured out per 1,000 of the loan, the amount being borrowed. So first of all, you got to figure out what number can we use, the appraised or the purchase price, whichever's lower. Then we've got to figure the amount we're putting down so we know the amount being borrowed, borrowed, borrowed. We divide that by 1,000, and then we take that number and we multiply it by the principal and interest factor number. And they will give you this information in the exam test question. They will say a rate of 5% for 30 years, and you know your factor number is 5.37. So you take the number of $1,000 you're borrowing times that number, and it gives you the principal and interest payment. Here's how I've seen this show up. They give you the amount being borrowed, the rate, and the term of the loan. You figure out the payment. I've seen them give you two different payment scenarios, and they want to know the difference between the two. I've seen them give you an appraised and assessed, an appraised and assessed and a purchase price amount. You got to figure out which one they can use for lending purposes minus their down payment, and then divide the amount being borrowed by 1,000 and find your factor number. And another one that I've seen is, what is the maximum term of the loan a buyer could have and keep their payment under $700? Which means you've got to go over and find the interest rate that they gave you and multiply it by the factor number for 15 years, 20 years, 30 years, and whichever is the most and keeps it under that dollar amount, that's your answer. Now, some of you have maybe been studying from a book that just has 15 and 30 years in it. I found this one online that I'm borrowing that has 15, 20, and 30 years. The one that you might see at a test center might be 15, 20, 30, 35, 40 years. It might have more year terms, but it still works just the same. Now, when you go to the testing center, you do not need to have this factor chart memorized. Would that not be awful? You do not need this memorized. They will have this chart there for you, laminated and maybe even taped to the table. But I would expect to use this several times. And again, it's a way of figuring a principal and interest payment based on the number of $1,000 borrowed multiplied by the principal and interest mortgage factor number. Okay. I hope this was helpful. Good luck with math. I know you can do it. And we'll see you on the other side when you've got your real estate license.